The world has changed dramatically over the last 6 months, both from a medical and economic standpoint. Nobody could have foreseen this global pandemic nor have comprehended the devastating impacts that were about to unfold. Although quarantine has given all of us plenty of time to spend with family, complete unfinished projects around the house, helping others in need, we also began to reflect on the past, asking ourselves, could I have been more financially prepared? So how can you become financially prepared in these extraordinary times? My name is Jim Leo. I am partner at TVH Group, president of TVH Financial, and private wealth advisor at Raintree Financial Solutions. In today's episode, I'm going to go through a blog post written by Ben Rovee, founder and CEO at Strategic Financial Designs, titled Becoming Financially Prepared in an Uncertain World. But first, a word from my sponsor. Well, thank you for joining me today and listening to another one of my podcasts. I thought I'd change things up a little bit again. The last few podcasts were about my critical illness and the whole story behind that and my recovery. I probably will have one or two more episodes to discuss the surgery itself. But today I wanted to change things up and discuss a blog post that I'm going to be sending out through my TVH News You Can Use. So you're going to see both, if you do receive the e-newsletter, you're going to receive both the link to the podcast as well as the actual article. And the article is written by Ben Rovee. He's founder and CEO at Strategic Financial Designs. And the title is Becoming Financially Prepared in an Uncertain World. And boy, have we been dealing with a lot of uncertainty over the last few months this year, being 2020 with COVID-19. And we're going to talk about more what things you could do from a financial perspective. But, you know, if we kind of compare what happened with 2008 and 2009, we were dealing with a lot of uncertainty back then. The main difference is that the uncertainty and the stresses that we dealt with in 2008 were specifically related to our financial situation. People lost jobs like they currently have as well. People were in a financial chaos because of what was happening during the markets and the financial systems globally at the time. There was a lot of volatility in the markets. And again, the main stress for everyone back in 2008 was the fact that we were heading into a recession. Financially, there was a lot of unknowns. There was fear that the banking systems would collapse in many of the countries. It was pretty serious. Now, 12 months later, we're dealing with a lot of chaos in the world as well. And, you know, we're dealing with similar financial stresses and concerns. People have lost jobs. People are not bringing in money. Businesses are failing. A lot of financial stress that we've been dealing with. But to add to that, we're obviously now also concerned about, you know, contracting a virus that could get us really sick, or it could potentially get us sick and have long-term issues that an individual could be dealing with, or, you know, at worst, it could be very fatal. So we're dealing with a lot of chaos right now, financially, as well as there's this fear of an invisible virus that could potentially get us very sick and can potentially end our lives. But today, I'm going to focus on the financial side of things because I'm not a doctor and I can't really give a lot of advice on what to do with the virus. But I am a financial advisor and I can provide some advice on what we can do financially. And I'm going to use the blog post from Ben because a lot of the points that Ben makes, I do agree with, and I'll probably expand on a couple of them. But for some of you, if you'd like to just read the blog post, you'll be able to see it in our News You Can Use. One of the paragraphs I will read right now from Ben's blog post is this: everyone owes themselves the opportunity to have financial peace of mind. Now is the time to figure out what you can do to be better positioned financially, now and in the future. Consider the following, or consider following some basic foundational principles that focus on building essential groundwork and a strong defense for your financial life. A well-positioned defense is the key to creating a sound financial life. And here are a few basic fundamental rules that will help you create a defensive financial foundation. Now, keep in mind, this wasn't written just because of COVID. These are basic rules that we need to follow to protect us in the event that we're dealing or potentially will be dealing with a situation that will provide financial chaos to our world. So again, if you follow these rules, there will be another event in our lifetime. We don't know what that's going to be. We don't know what the trigger is going to be. We don't know how long it's going to last. But if you follow these basic rules, you should be able to weather that storm. So let's go with rule number one. Rule number one is create efficient, full replacement protection for peace of mind. So we're looking at protection, not just your life insurance and critical illness, which are very important, and we'll touch on those, but also on, do you have the right type of protection for your assets? Do you have the right protection for your home? Do you have the right protection for your automobiles? So you want to make sure that you take the time now, especially if you're not working full time or if your hours are reduced and you're looking for something to do, you should complete a full insurance and benefits review. The reason why this is important, quite frankly, is the worst time you want to find out if you don't have the right coverage or the right amount of coverage is when you're making a claim. I'll give you an example. I know there's a lot of businesses who are looking at filing a class action lawsuit against insurance companies because they're not paying on the benefit of business income interruption. And business income interruption, it's not something that, again, I can offer. I'm not licensed to provide advice on, but at TVH Group, we have it on our office location because we own our office location. And the way those contracts are structured is you only would receive a payout if income was interrupted, your business income was interrupted due to some physical damage to the building that you have insured. So, as an example, at TVH about 2 years ago, we had a flood in our office, which basically covered, I believe like 80% of our office was in about half a foot of water or so. And it took a few months to clean that up and clean it up properly so we wouldn't be dealing with mold, and to have new flooring all redone again with baseboards and so on and so forth. And our income was disrupted as a result of that flood. And because our business income was disrupted because of the flood, which happened to our business location, we did receive some form of a payout. COVID-19 is not structurally impacting a business. That's not the reason why there's a business interruption with a lot of these businesses. They're being shut down because of a virus. And people are finding out now, a lot of business owners are finding out now, that what they thought would cover them, as long as the business income was interrupted, is actually not what they're being covered for. It has to impact the location itself. So you don't really want to find that out, right? Same thing with your home. If your house catches on fire and you only purchased, $500,000 of coverage and your house is worth over $1 million to replace, the worst time to find that out is when your house is on fire, because in that situation, obviously, you're just not going to have enough coverage. So do a full review. And if you don't have an insurance broker who can help you with your home and auto insurance, reach out to me, because I do have some very qualified people who would be able to go through that assessment with you free of charge. Having perfect protection is critical in guarding against unforeseen risks and events. So that's another part of the rule. So as an example, I went through again a few episodes talking about my critical illness. Thankfully, I had critical illness insurance protection. which paid out a lump sum payout 30 days after my diagnosis of my critical illness. And what that allowed me to do, quite honestly, is it allowed me to recover. And the only thing that I really had to worry about was getting myself better and getting through my recovery period. I didn't have to worry about my finances. I didn't have to worry about my mortgage payments. I didn't have to worry about paying my bills because I had the right type of coverage in that situation. And it really reduced my level of stress as a result of it. Another one is to review, update, or complete your important legal documents. An example of some legal documents that you should consider reviewing are your wills and powers of attorneys. I don't know how many times I've sat down with a client and I've asked for them, A, if they had a will, and I would say about 50% of the time, the response is no, we don't have a will in place. And I would look and they'd have, children, little kids, assets. So if you don't have a will, I suggest that that's one of the things you start working on putting together. And again, if you don't have a lawyer that you can speak with who can assist you with the will planning process and power of attorney planning process, reach out to me and I can refer you to my partner, Sonia, who is a lawyer, and she does assist our clients with putting wills and powers of attorneys in place. Now, the other half that say they have a will, many, many times, I would ask, well, when was the last time you did a review? And it would always be, oh, when we originally put them together or set them up, which, many times was a decade ago, 10, 15, sometimes 20 years ago. You should review your wills whenever you have a major life event happen, especially if you're adding kids to the family. So again, if you do have a will and it's been more than 2 years since you've established that will and power of attorney, and or if you had a life event that has changed, then you might want to pull those wills out and go through a review to make sure that they're still valid for your situation. And again, if you don't have anyone that you could speak with to assist you with that, let me know and I can connect you with my partner, Sonia. Review your life insurance coverages. That's also very important. Many times we put life insurance in place, and kind of like the will, it goes into the drawer and it's forgotten. What you might want to do is, and it's especially if you've had some major life events, as an example, if your income has changed, if you've added significant debt, if you've added a family member to your family, you might not have enough insurance coverage. So in that situation, you might want to perform a review. So reach out to me again if you need some assistance with that. We do have some wonderful tools now where you could input some data on an electronic application, web-based application, and it will assist us in determining the appropriate amount of coverage that you should have. The next rule is to seek out more efficiencies in premiums being paid for coverages. So what that really means is, most people are paying for their premiums out of their bank account, which is normal. But there might be some other investments that are generating forms of income that, if those investments, if the distributions are reinvested, you might be creating a bigger tax problem for yourself. So we could potentially redirect some of those distributions into paying some of your insurance coverages. So that's something, again, we could definitely try to help identify and assist you with. And ultimately, in rule number one, use a financial professional to help with this evaluation and analysis. So if you don't have a financial professional that you trust and you'd like an evaluation from me, please let me know, and I would definitely be happy to go through your situation and assist you. Rule number two, save at least 15% of your gross income. This creates a potential to overcome various wealth eroding factors in the future, such as, and I'm going to list them, taxes. Taxes are something that we can't plan for. There is concern now that with the debt that our country has added on because of COVID, that taxes will most likely increase down the line. And, going back to the 15%, we used to read the wealthy barber who recommended 10% of your income should be set aside. And now we're saying that 15% is, if it's doable, is the goal to help you try to deal and avoid some of these situations. Inflation and cost of living. There is concern that inflation will increase down the line because of, again, all this debt that we've added. So we want to try to protect against that. Market fluctuations. We've dealt with a lot of that in the last few months. Things have stabilized since about, I'd say, March or April, but there will be other corrections, and it could happen within a couple of months. It could be in a few years. But by having a good cash base of 15% save, you could help weather some of those storms. It'll also help you with planned obsolescence. Now, some of you may have never heard of this. Planned obsolescence, and sometimes I have a hard time saying it, is, as an example, technology that's planned to be obsolete over a period of time. I'll give you a brief example. Over 20 years ago, I worked at an electronics store, and one of the electronics that we would sell were TVs. And at the time, the best rated or most reliable TVs were actually made by Mitsubishi. And we would always tell clients, and it was very true, that if you turn on a brand new Mitsubishi TV, and if it works flawlessly within the first 48 hours, there was a 90+% chance that that TV would still function 20 years down the line without needing any repair. We rarely got Mitsubishi TVs back for repair. It was always a lot of other brands that on a regular basis we had to send in for repair. Now, a lot of these electronics are designed to fail after 5, 7, 10 years. And they're designed that way because the companies that are manufacturing the product just want you to buy new product. And they do so by also forcing you to buy new product, with having the repair bill be, anywhere close to equal to replacement, to sometimes even more expensive than just replacing your product. So they are designed that way. That's planned obsolescence. And then we have technological changes. Technology that was valid 10 years ago, especially with cell phones as an example, are really no longer valid today. So in dealing with the technological change, that's ongoing costs that we deal with in society. This will help you deal with some of these things. Rule number 3 is build liquidity. So accumulate at least 6 months of your income into liquid and non-risk-based positions. So really what we're talking about, even though right now the rate of return is very, very low because of the interest rates being so low, but just having access to cash, because as the old saying goes, cash is king. So if you can try to build about 6 months of your income into a liquid savings plan. We're not talking about investment portfolios. We're not talking about ETFs. We're not talking about individual stocks. We're talking about putting your money in an old-fashioned bank account, savings account. And there are high yield options. Again, high yield is low yield right now, but there are options available outside of the bank that would potentially pay you a little slightly higher return, but they function just like the bank accounts. Liquidity can be a powerful tool when presented with unforeseen events, emergencies, and opportunities. So if you have access to cash and all of a sudden your income dries up, it'll help you keep afloat for a while. On the other side, if you have access to cash and an investment opportunity presents itself because of the chaos, then you could take advantage of that opportunity. Now, having that cash also positions you to have the ability to operate on a cash basis as well. So just see if that's something that you're able to do. Now, the final rule number 4, is to take control of cash flows. So you should complete a cash flow analysis to get an accounting of all inflows and outflows. It's amazing how many people that over the years that I sit down with, and we try to put together a plan of sorts, and they really don't have an understanding of where their money is going or how it's being spent. And I'll use me as an example. I'm a techie guy. And when the iPad first was introduced, I really wanted to justify purchasing that iPad. And at the time, I would go out and buy a newspaper every morning. And where I lived, the newspaper from Monday to Saturday was about $1.50, and then on Sunday it was $2.50. And every morning with that newspaper, I'd also get a coffee at the coffee shop, and I would go home. Now, to me, it was pocket change, right? It was just change in the coffee cup holder in my vehicle. But when I calculated what that cost me and what I was spending on coffee from the coffee shop and a newspaper, it was about $680 over the year. Now, at the time, the iPad was being sold for about $700 a year. So I thought, if I get myself an iPad, I can actually now read multiple online newspapers and not just one. So that was a positive. And because I wasn't going to go out to the coffee shop, I could make my own coffee at home for pennies on the cup. So it was, in year one, a savings for me. Now, again, this was my way of trying to justify buying an iPad. Let's be real here. But the bottom line is, I had no idea that I was spending $680 a year on newspapers and coffee. So that was an eye opener for me. And again, when I go through that process with clients, sometimes they're quite surprised on what they are actually spending their money on. So, understanding the circulation and flow of your money is vital in taking steps to optimize your financial health. I had clients who they didn't realize they were spending about $1,000 a month at the LCBO. Now, they weren't alcoholics, they just like really good wine and really good scotch. But it was a bit of an eye opener for them. That was $12,000 a year they were spending on booze. And, they decided to make some adjustments because they were having some cash flow issues. Now, if you receive a tax refund, you might want to consider depositing it into a high yield savings account or pay off high interest debt. The reason why that's important is typically people will get a refund and they'll use it for a vacation or to buy, a vehicle, a boat, whatever it might be. But if you're not able to build that 6-month savings account, you might want to use some of your tax refund to help build that for yourself. Or again, pay off some high interest debt. I'll give you another brief example. I've had clients who would have, as an example, $10,000 sitting in a savings account, earning 0.5%, and they would carry $10,000 of credit card debt where they're paying 22%. And sometimes they would ask me, what should I do with that? Or how can I get a better return on my money? And for me, it was, well, use the money in the savings account to pay the credit card debt. And that way you'll save about 21.5% or so, because right now you're paying 22% on that money. Same thing. If you get the refund and you have credit card debt where you're paying, 10, 12, 15, 22% in interest, just take it and pay off that credit card. You'll save a lot of money in that scenario. So what other things can you do to improve or temporarily improve your financial position? One of the things you might want to consider, it's not an ideal, but you might want to consider temporarily suspending contributions to your retirement plan. So if you are making regular contributions into your RRSP and you're struggling with cash flow on a monthly basis, that's one thing you might want to consider pausing for a period of time until you can get things or get yourself back on your feet again. And the final thing, again, is to seek out the assistance of a financial professional to help you in assessing what is most appropriate for your own unique financial life. If you require assistance, then reach out to me. I can be reached at financial@tvhgroup.ca, or you can call my office at 647-727-4668, or you can check out our website at www.tvhgroup.ca. Thank you for listening to this week's episode. Once again, my name is Jim Leo. I am partner at TVH Group, president of TVH Financial, and private wealth advisor at Raintree Financial Solutions. And I'm hoping that you continue on listening. I do enjoy putting together these podcasts and providing you with some information. And if you have some topics that you would like for me to host an episode on, then let me know. And hope you all have a wonderful and fantastic day.